What's up, guys? Welcome back to the channel. Today I want to do a quick video on how I chart my risk analysis on futures. I'm going to do just a quick intro to futures on this video, and then on a next video I will dive into futures a little deeper. But MES is what I like to trade, and then the last digit here, the U, is the expiration. And you can just, if you don't have those memorized, you can Google it, right, and find out the expiration. This is the next expiration date. So where we were trading MESM, which expires June 18th, I think it's coming up. So this is the previous one. So normally on the MESM, I would have a vertical, I would choose a vertical line like this, and it just happens to be purple, and I just leave it that way because it stands out, and I'll put it right there. So we are getting really close to expiration, and if I'm not mistaken, it expires at 9:30, basically at market open. So you have the night before to trade up until this the morning of June 18th. So anyway, I'll put a vertical there, and then what happens is whenever you get on Robinhood, you get close to this expiration, this automatically changes over. So I'm not really a big fan of that, but it switches over to the next one that expires in September, which is MESU. So if you look it up, the M basically is a abbreviation or a code letter for June, and the U is a code letter meaning September. And there's a whole chart that you can look up. So, but what usually happens is when this one comes into effect, the next time you log in and say you click futures/MES, it's going to automatically take you to MESU, the September expiration. And oh, look, my drawings are back. Okay, there we go. They weren't there, now they're there. So you have, there's your June 18th. I'm going to move it over to 18. None of this was here a minute ago, so I was going to show you how I map all this out. We'll just do this real quick. So this is a year. I have this set at a year and 10 months. All right, we'll delete this, and then this is the old one. Okay. So we have, if you open up your futures tab, you have, or whichever futures you're trading, you will have a trend, right? So I have this at this top here, and then this top over here. Okay, that's a trend channel. See, when the top and bottom move together, it's a trend channel. So we're actually going to delete that. We'll start from scratch. Instead of a channel, we're going to use lines, and I'll grab the top here, and then I like this. This seems extremely stretched right here. I like to grab all this volume right here. Looks like a lot of rejection off that line there. So I don't mind going off of that. And I'm going to go way back to this actually. And then we're going to grab this bottom here and this bottom here and just stretch it way into the future. Okay, and then we can actually grab, we'll grab this one and pull it back, see where it falls. So we're grabbing 1 point here, 1 point here, and it won't let me go past 2019. So that's okay though. I have a feeling this would reach back and touch another point back here, but that's okay for trend lines. That you can see these bottoms I have circled. So these are the where it's reached the farthest down, and I have, there's that expiration. What we can do is go ahead and throw on there a the next expiration if we want. So vertical line for MESU. Okay, it says the 18th. So we can go to September, zoom in a little bit, and this should be 18. There we go. September 18. So that'll be the net. This is your trading window for MESU. Okay, and then how I make the risk analysis is I've pretty much just look at the S&P 500, and I base this off of like historical falls, basically historical crashes, and so I've gone back all the way back to 2000, and I just looked at this crash right here. This is where it was at the top, and this is where it hit the bottom, and this is the length of time that it took to recover and get back to that point. So that was actually 6 years for this recovery, and that was a 50% recovery. So that's pretty insane that the market can go through something like that. But my theory is, okay, if we're going to go through something that like we did in 2000, then a lot of people are going to be struggling, and everybody's going to be working overtime anyway. So if my account goes under because of something like this, then it's everybody's already screwed, basically. So like I'm not going to be mad if something crazy like 50% happens. Here it goes again, the crash of '08 is what everybody talks about, the famous .com bubble burst. So here it happened again, the '08 burst, 57%, and then recovered back to its previous point, and that was 5 years and 4 months. So these aren't great examples because I don't really go off of this, but this is the extreme. I just know in the back of my head that these two things can happen. 50% is a huge number, and so if you want to be super risk averse, you want to be on the safe side, you can definitely set your window at 50%, and you can stretch it all the way out to 6 years if you want to be super safe. How the saying goes, you're not going to make anything unless you risk some. So I'm willing to lower my window a little bit and lower my return a little bit, just due to the fact that if you're still working, you're still making money. This is just like a side account, so it could take longer to recover, and that just means you have to wait a couple years. But if this happens, yes, it would suck, but it's also not going to be the end of the world. So with that being said, and the Great Depression was roughly like 86% on the S&P. So yeah, there's some big drops there, and then you can look at the more common drops as we've gone along. Here's a big one in 2019. I forget the exact cause of this one. This was 7 months and 19%. And this is COVID over here. This is COVID-19 basically, in February of 2020. And then this the decline from that. So, and you can see where it impacted the RSI and the MACD of all the seller sentiment. So this is why you would want to buy all the way on this downside and wait for the recovery. This is a good one for me to go off. This is about what I use. I said nearly 2 years and 19%. So this is close to the amount of drop that I use as my risk analysis. And then a little bit longer, more like 2 years for the recovery. And then you can go on and study this as many times as you wanted. You can grab it here and then go over to where it recovers, and the drop is 26% to 2 years. So you can look at history and see how many crashes happened, how far they went, all that stuff, and essentially take that, since this is the S&P 500, right? Take this over to, there we go. Sometimes it seems like it's saved. If it's not saved, if you just type it in, but if you have it linked to saved color, then it'll remember your drawings. So that's interesting. All right, and essentially what we're going to do is grab and put a top on it. So that's the top of the market. You're going to grab that, and then you're going to simulate that drop. So we could just say 20%, and then you can go into the future, say, just to give you a visual, there's 2 years. So if it takes 2 years to recover, this is where it'll be. There's a 20% drop. This is where some of those ended up at 50%. So that could be pretty rough if we're going into a real market crash situation. But that's where you probably need to set some stop losses and get out. So I'll be honest, I've been trading more at in this realm here, 20 or 19%, and then on roughly like 2 years recovery time. So this is where I've been keeping mine, and then as this, I keep it sort of a warning color actually, and then this every time the market, so it was here, right? And then every time the market breaches that top and sets a new high, I'll just move it up. So it's always at the top. And then that's another 19% drop and a 2 year recovery. And I've been trading this setup so that it gives me a visual on how much the market could fall and how, and in a minute I'll explain. I use this to set my position sizing. So you can use this and set very low position sizing, because you're not just going to buy up all the contracts that you can afford, because that would be stupid and you're going to blow your account that way. So typically if you just do like one micro contract, you can get in and get out, and also you can keep in mind that the amount that it's going to move on a single contract, and it'll close on its own at the end of the expiration, is going to be between these purple lines here. Like MESU is just between here and here. If it goes straight down and then meets expiration, it might end up in this area right here. Is kind of how I look at it. This is what I've been doing. But if you want to look at the dot-com bubble and all of that and say, okay, 50%, and then be way on the safe side and say let's see, it was like 5 years. Okay, this would be your risk window. And then you can use, you'll essentially use this dollar amount. So we're at 76.12 right now. And then this is, you can use your dotted line, 3,800, roughly 3,802. So from there to there, it does the math for you. That's negative 3,800 points is what you would call that. It's $3,800 on this futures contract. So you can use this number to find out how much loss that would be on one micro contract. These are the micro contracts /MES. It's not the mini. The mini would be /ES, and that's times 50, and then the micro is MES, and that's times 5. So every dollar amount that this moves, which in this crash here would be $3,800, 3832. That would, if you were in a mini contract, it would be times $50 per. So that would be insane. You would be totally broke. Which again, keep in mind that this would be this is your expiration, September. So it would be a straight down red line. I'm talking like not even this angle right here. Like say you grabbed a trend line and you found this angle. Okay, this is the rate of which it fell, this angle right here, and you took that fall over to here. That's where it would end up by this expiration, midway through this trend channel. It wouldn't be way down here. I mean, this angle would literally have to be like this. So the world is basically burning, and crashing if we're actually reaching that point. Could we take this back to 2008 just as a visual? Okay, this crash, you could, okay, let's just do this. September, okay, June, they're 16th. Okay, let's go down to the daily. We're gonna put what I use on futures over on S&P, because it lets me go back as far as the 2008 crash. There it is, and then we'll grab another one and we'll put it on September. Okay, September 19th. So this is the rate of which it fell, and how long. Another thing you can actually look at is how long it took to crash. Okay, this right here took a year and 4 months to reach the bottom. It did not happen overnight. You can kind of take all this information and look at the angle at which it happened in this one contract period of time. It went whoop sideways. So this angle at which it fell versus what you're using on your futures tab as your risk assessment, okay, at this angle, and say, okay, if this was the .com bubble burst, would it be at this angle right here? It's more likely that it would be like this. You know, it's going to happen over time. So that puts us here at the end of the expiration. So this is kind of the reason why I don't use the 50% box, because this by this expiration would be insane. And as a side note, the market does have stock market circuit breakers, so that if it crashes too much during one day, there will be a 15-minute pause at 7%, 15-minute pause at 13%, and if there's a 20% crash from the prior day, it will pause for the remainder of that day. This might act as a pretty good sign for me to get out of a trade and possibly wait for the recovery. Nevertheless, I'll use the larger one as the explanation here. So 50%, 5 years to recover, and how you would use that to calculate your amount lost is, since this is the micro, it's times 5. So 38, 32, got my trusty calculator here, 38, 32 times 5, and that's $19,000. So if you had a buy, this is another thing, is like you would, because this is a high on the RSI and high on the MACD, you would not in a million years have a buy contract at the top. You would buy this, maybe potentially buy this. You would probably be in right here or here or here, but you wouldn't, if you have any common sense, you wouldn't be buying a contract and trying to ride it out from the very top. If you did, it would be negative 19,000. So you can take your max risk. You can take a annotation bubble, and you can say, 19,000. It's actually 19,160. That would be your max. And the way that you use this, all right, not done yet. So you have your max. This is how much you would lost in this period of time. So you're saying that if this happened, if this crazy event from here to here happened, and you reached expiration and you lost 19,000, then what you want to do is, and this is just for visual, I'm going to use this gap here. I'm not going to go off the date, but let's just make it look about the same. Okay, this is to represent your next contract. What you want to do is have enough money in your buying power to be able to buy it, because you're still interested in buying the low. Just because it crashed on you and you lost 19,000 doesn't mean you're going to stop trading. It means that you thought ahead of time and 19,000 was okay for you to lose, so that you can buy it on the other side of this purple line here, this expiration, and then ride it on the way back up. And you would take, let's see, and you're wanting to buy down here and then ride it up the other side. And it might only recover at a rate like this, okay? And then you have to buy it on the other side of that one and get it back over here. But you're eventually going to make it back, because this is my bread and butter of how I trade. This is the whole thesis behind it, is every time you've seen the S&P crash, not only does it recover here, here, look, crash, recover here, crash, recover here. Not only does it meet where it was, but it what? Exceeds it. So that's your whole thesis on why this works. Because when it crashes, it not only is going to eventually be back to this line here, but it's going to exceed it. And that's just, you can't definitively say that because you don't know the future. But if you look at the history of all of these charts, that's just what the history is telling me. So this could continue in that pattern. Another vertical line, put it over here. That's your next, that's your, and so on and so forth. Those are all your contracts in the future. And this is your doop all the way back up. And that's because that you kept a $19,000 buying power to the side. So how do you use that as your sizing a contract? You're going to look at your buying power. So if I go to futures real quick and scroll down, futures buying power 32,000 is what mine currently is. Okay, I would take that number and divide it in half. So you're looking at 16,000. Let's erase all this because it looks ridiculous. And now that I have all this cleared up, another thing that you sort of have to remember is, since you're not losing from this top, you didn't have a buy contract up here. You probably bought right here. You're going to have to do this math like as you're trading. Say you bought a contract right here at this dip, you would just take your box and grab the dip. Say you got it right here at 65, 64. All right, then you could pull that to the bottom. You would leave this chart, leave your risk chart, your big one, right? And okay, then you could make this one back white again. All right, so it gives a little contrast. All right, this is your actual, if you bought a contract here and you're riding it and then it dipped on you and you were going to the negative, you could ride that down to what would be a 2008 level crisis, negative 50%. And because you were in right here, okay, that is only 2811 on your particular contract. So 2811 times 5 is 14,000. So you would calculate this number say I have a position here and it starts going in the negative. I could draw this box 2811. I'm going to multiply that by the multiplier of the contract that I'm trading. That's times 5, and this brings this number to 14,000. 14,055. And pretty much like, go look at your buying power. I got 32,000, half that, so 16,000. And the reason that I'm halving it is because if this dips in one crazy swoop and this crashed you out from this position that you're in right here, and for some reason you didn't sell it up here, this is all part of what's crazy to me. Is if you were in a buy position here and it did this, it would be positive like thousands of dollars. And if you're watching, you would put a sell under that to protect your profit. And whenever it dipped, you would just be in the profit. You wouldn't actually, for this to go up like this and then dip. I mean, it would, real life situation, it would be more like it would only come up this far and then dip. All right, and you're just in the trade. But yeah, that's 14,000 and that's 1 micro. So you can see how much money it would take to really expand. But the reason that this is attractive to me is because this is so scalable. This is the more money that you have, the more you can scale up. So I'll take all this away for a minute, and then we'll talk about how I've been sort of trading the last couple years. Let's take this to 2 years, and then we'll take this to 20%. Okay, this is how I've been trading because it kind of stays, it's also within this, within the trend line here. So it's kind of, it fits where the chart actually is. This trend is going up, this is the top, this is the bottom. Okay, and then we're also risk averse because we're setting stop losses, and we're not buying this up here. The position is more like here. So if my position was here, this is going to be where that 50% line was, which is down here. So it's, if you can visualize it, that this is not where I'm buying them anyway. I'll be buying them hopefully down here already. So that's already a, that's 14% right there. I would be buying it right here. So this is a 14% crash off the top is where I would be buying, and then another one to equal that 50. So that 50 line is down here, 37.85, right where I have this max risk. Okay, so this would be actual max risk, and then I've been trading up here, so something in this range, and that's primarily because of the fact that I'm buying lower, I'm not buying up here, and the crazy angle aspect. It's not, you can lose all the way up to here, to the next expiration, and that would be already a bad loss. But like, it's for it to go straight down to lose 50% in a day, like that's kind of just a wild imagination. Anyway, so I would do that, and then I would whenever it starts to fall, you can set yourself up a buying sort of I did this for a little while, schedule. So whenever it dips like a quarter, we can use this box as a buying schedule, sort of. All right, and this is the halfway point, and then this is where you really want to buy down here, and this is up here is where you're not really that interested in buying. So let's say it dips like a quarter of the way, like whoop, down to halfway on this box, this top box. All right, that could be a buy. Oh, I lost my circle. There we go. Okay, and then that's 1 micro contract, and then you can say, okay, if it reaches below this 50% line, I'll buy another one, and then when it reaches down here, I'll buy another one, and that's 3 micro contracts, and that would be, you would have to measure each one individually. Okay, so this position would be, there's a 20% loss. Well, over here you read this 20%, and then this position would be, okay, negative 17. Essentially, you would do the math on each position. So you would take this loss, 1271, times your multiplier, 63.55. So that's, and you could annotate that. Text is what I meant to grab earlier, not the call out. Okay, so this first position you could put over here, that would be 63.55 when it reaches the bottom. And then you just take your box and measure your second one. You bought another position here, and you're buying this to go up. Buy to go up, buy to go up, buy to cover. You're covering this loss. So when it recovers to this level, this one will be break even, but this one will profit on the cover. So 78, 783. 783 would times 5 would be 39.15. Put it beside this one. Okay, this is just an idea of something that you could follow. 39.15, and then And then this final position, say you bought another one right here, another micro, okay, and rode it all the way down. Okay, that would be negative 200. So 204 times 5, roughly $1,000. All right, so and then so this is how I would measure all these positions. Like I said, this is what I've been doing for a few years, and it kind of seems to work. Buy it here. If it continues to fall, you buy this one to cover, and if it continues to fall, you buy another micro contract to cover. And your max loss, if this one goes all the way down, this one pulls all the way down, this one pulls all the way down, and this one pulls all the way down, you can add these up, and this is your max loss. All right, that's $11,000. So if all of these went down to here, you would be out $11,000. And if you remember, our buying power was 32, and we halved it. That's 16. So like, we don't want to dip more than 16,000 because we won't be able to buy it back on this side of the contract. So essentially, if this is getting really close to the expiration, and you're close to 16,000, which is my max, being able to buy it back on the other side, my max loss, I would just sell it at a negative 16,000 because it's going to close anyway at this expiration right here. And then I would go to the next digit, so after September, October, November, December, January. So the next one would be January over here, and you would sell this before $16,000 loss, and then buy it on the other side over here for the recovery. And yeah, it could keep going negative. I mean, this is just a strategy, right? It's not a fail-proof strategy. It's not to say that this is this is gonna 100% work all the time. But this is just what I've used for a couple years, and it's made a few thousand for sure off of it. I don't know the exact number, but real quick, I'm gonna show, now that I have that sort of, you have that strategy down to where I hope all that makes sense. I hope I didn't just breeze through that and it was extremely confusing. I hope that, and please go back and watch again if it was confusing. But let's give one more example of the years down here, like going this way with this is just for a visual kind of. It doesn't really, it's just to show you how long it's going to take you to recover that at max loss, just to give you a good idea. Another way that you can use this is say, okay, my max loss is 16,000. You can take your max loss buying power, your half of your buying power. So let's say 16,000, and then we're going to divide that by 5, which is one micro contract, okay, and that's 3,200. See, another way we can sort of back test this is set this at 3,200, which is roughly here. Let's line that up with over here. So like I bought it at the beginning of this contract, and it went all the way down, which it would have actually expired here, and the crash would have continued over here realistically. But let's just say, for example's sake, that it happened all in one. Another way that you can use this is just tell yourself, I'm not going to buy a micro contract unless it reaches this far down. Like, I'm not, like this dip right here, whoop, it looks like a good buy. If you're using this, if you want to use this as a risk analysis, just tell yourself, I'm not going to buy unless it dips down this far. That's it. That's as easy as it is, because then you know you're using 50% pullback from the 2008 crisis as an example, and you're not going to get in that risk unless it's down this far. And honestly, that's not a bad way to look at it, because this is so far up above this trend line that the market kind of does need to be corrected back down into this trend. If you use this example back here, say we were back in January of 25, and this happened, you line this up with the bottom of this box here, and look at there, you would have bought this dip. You wouldn't have bought, you would maybe have bought this one because it just touched your line. Okay, but this one is way under your line, so this is a definite buy range. So there's a good example of like how you can use this number. And the bigger your account gets, you can layer in those other micro contracts. Let's put this back at the top. So this is a good beginner way to do it. Divide you got half, take your buying power, half it, divide, if you're going to do one micro contract, you would divide that by 5, and you would get your risk limit, and don't buy unless it's under that. And you're going to ride, you could ride that micro contract all the way to the end of that, and you have to mentally tell yourself, it's okay if I see a red number that says your risk limit, as long as I'm watching it on September 19th at expiration, and I buy it back as soon as that next contract opens. And here's the sort of the trick to that too, is you can buy the next contract as soon as it starts trading. It starts trading before September, before expiration. So before the September 18th range, you can actually buy the next contract. But the trick to that is it's like $50. You'll usually see like a buffer. It's like a $50 higher premium that you're paying because you're buying the next contract ahead of time. So once you see this at 9:30 a.m. on September 18th, you'll see that buffer close up. There's no longer a $50 difference. Essentially, it'll meet whatever the price is on this side will meet the price on this side, and then that will be the current contract that you'll be trading, is the after September 1. Anyway, I know this gets deep, I know this gets confusing, but I hope that makes sense to you, and we can now delete this. And I'm going to screen share real quick, and I'm going to show you where you can see the multiplier on futures trading. And I'm going to do a futures video coming up soon, but this is a way that you can like measure your risk analysis and how much you want to get into a trade, and using the history of the charts to explain to you why I might think that the stock might fall this far. All right, let's screen share, and I'll show you where you can find the multipliers on the Robinhood app. All right, here we have the Robinhood app pulled up, and you can see here if you have futures orders already in, or you have a position, obviously your futures will be here. If you're just now getting into it, what you're going to find is scroll all the way down to your categories, and you can see once you get to your lists, you'll see a futures tab. So you can hit futures. You can select your positions here. So here's MES, and then if you scroll down, you'll see ES. So this is where you kill 7613 is S&P 500, and these are called the minis. These are called the micros. So that's essentially what I trade. That's all I trade is the S&P. I don't really get on here and mess with gold, or if you want to, you obviously have NASDAQ, gold, silver, copper, crude oil, all these other. But real quick, you just tap that, and then you scroll down, and you'll see contract specs, how much money it takes to buy the contract. So this used to be, this is going up. This used to be $2,300 earlier this year. And here's the multiplier, and it gives you the exclamation right here. Multiplier is the dollar value of each full point of price movement. So each time this over here moves $1, not, you can ignore the cents, but when it moves $1, you go up or down $5. So this is why on the upside it's really good, because you see a 5 times movement, and on the downside it's really bad. So it shows you your leverage, and I'll get into tick size and tick value and all that stuff on a futures video. But this is the primary, this is what you really care about as far as how crazy this thing's going to move. That's $5. So yeah, each time you buy, I was talking about layering in contracts. That would be $2,700 for one contract. Then the next one comes along, and you would buy another one at $2,700. So that's a little over $5,000, and all that just adds up. So as you have more money, you can afford more micros. And then just to show you the E-minis right here, and that's 27,000 because it's essentially times 10. The ES/ES minis is times 10 of a micro. So 10 micros equals 1 mini. That's why you have $50 multiplier and 27,000. So you can start futures trading by layering in micros. You can do 1, then 2, then 3. So right now, the most I've ever had is 3. And then, that's why I say it's perfectly scalable, because you can scale all the way up to 8, 9, and then at that point, if you're buying 10, now if you're layering in, I'll still probably trade micros when I get to that point, because you get to layer them in and buy them as it gets lower. But if you're going to go in here and just buy like 10 micros at once, you can just go to /ES and do a mini, right? That's $27,000, and start doing mini contracts. But and here's your expiration. Last day to trade, September 18th. Another important thing to note on Robinhood is that the settlement type is always cash. You're not going to get the actual product, which doesn't make any sense for S&P, but it would be important to know for oil, because oil on most platforms, you would buy 1,000 barrels of oil. They would actually send you 1,000 barrels of oil. So this is very important to see. The settlement type on Robinhood is cash, and they don't mess with the whole, we're going to ship you 1,000 barrels of oil. They will sell your contracts, and you just get if it's profit, you get plus, and then obviously if it's negative, your buying power is going to go down. But they just settle in cash. So it's an easy way to do it. And this is where you can find your multipliers that I've been talking about. Probably could have prefaced this video with that, but that's all right. And with all that being said, I can actually show you back to, and here's where you can tap the title here, and it's going to show you that the September contract is active. It's showing us on the screen MESU. And then if I want to go back to MESM, which I do because I wanted to show you a couple trades that I've recently made and how this works, you can just hit MESM. And another thing to note, 75.50, that's a perfect price, for example. So let's do that. Okay, 76.18. So it's a little more than $50. Now that's like $68 difference. Okay, I'm gonna do that again. The old one, the contract that's expiring on June 18th, 75.50. If I want to go ahead to June contract and buy the next one, that is going to be about $68 difference. So I would pay a $67 premium to buy the next one. So you kind of can consider that $60 into your math when you're trying to figure out whether you want to afford to buy this next one or not. MESM, and I'll show you in 2 days made $400 basically using this strategy. So this is just to sort of prove that it works. Let's unlink and go back to MESM. go to hourly, and then I can show you how I use the strategy that I just explained to you on this fall. So this is literally June, okay? And then I haven't really been watching the news because when I trade, I just look at the charts. I don't really follow the news because the news will drive you crazy. So yes, you could probably make a lot of money if you're good at that, but this is just chart analysis is what I use. All right, so this was our top. So say if we had our risk box, our top would be up here. And then it started to fall. So I saw this fall and then this big fall right here. Okay. And then so we started to question whether this is a good time to buy or not. So I went in. This first one is June 9th for 194. And we saw this big red run here, and I would have bought that. And you can see it's the RSI is way low, and then the MACD is way low. So that's why we buy that. Because a lot of times the way the market structure works is when you have a big pullback like this, you have a big fall, you have a 50% pullback. It's just kind of average to see some sort of pullback. So falls like this don't just like keep running. It usually springs back and then goes again. As you can see that it pretty much what it did. Even this run right here, huge run downwards, 50% pullback. So that's why they call that the golden zone. That's where a lot of people take their trades. So June 9th, I would have bought this one over here, but by the time that I checked the market, it was already here. So this is where I'm not interested in buying because the 50% pullback already happened. And you can see the RSI right there is right on the 50 line. It's so averaged out. It's not even funny. So it's like you're just throwing money into thin air at that point. You're not using any sort of analysis. Like you don't really know whether this is going to continue or to continue downwards. This isn't really a spring. Here is a spring back. If you bought right here, it's very important to know the reason that you're making the trade. And there's no reason for me to make this trade, in my opinion. Okay, and then June 9th, it happened again. It started to pull back again. Okay, I went ahead and mapped this out. It was at this dip. So when I saw this RSI, and it's a little bit tricky because like MACD wasn't that low. So it was a little bit of a risk because this obviously would have been the best buy here because of the chart analysis. But I did see this low strength index, and this was very averaged out. So I was a little sketched about it, but I didn't get in at the bottom. I got in right here and wrote it to here. So just this little window right here was $200. Okay, and the way that I approach futures trading is super just kind of respect it and almost be scared of it, like because it can move like crazy. So just kind of respect the market and treat it carefully. So I do when I get in, it's for a reason that I believe in, such as this right here would have been a good one. And then as soon as it starts getting up, I set a stop loss at pretty much break even. It's a little bit of a window there that you have to wait, but once you get in a break even, then you're just in the trade for free essentially. And then the next one, I'll go ahead and map out real quick. All right, so you can see that was $200, 213, and what's crazy about that is that's me being scared of the market and like just getting in, getting out, and then see this right here, and then this low RSI. So I got in there, and then as soon as I set a stop loss under that and started raising it up, and then I got out right there. But you can see that right there. If that was 200 from here to here, then by the time it reached here, that would have been another 200. So that should have been a $400 run right there. And then look at this, how much the market just boomed after that. So you can imagine like me being not a very patient person, getting out right here and being happy with $400 versus someone who is willing to let it run. And another thing is like if you had a stop loss right here at break even, this almost came all the way back down and tagged that. So if this would have hit your stop loss. But say you just like set your stop loss down here and then didn't worry about it for a few days. Yeah, that would have been, and this is, you can flip this and it'll turn positive. So let's do that. We'll put that on our position down here, right here. Okay, and then raise that to, realistically, we're not going to get the very top out, right? But you could have gotten this average right in here. And that's 291. That's 300 up here. So maybe you would have got 300 for simple math. Okay, that's 300 on the futures price. 300 times 5, $1,500. This could have been a $1,500 trade if you're patient, and if you're like me, you're happy with this 200 and this 200. So you basically made $400 extra last week just by sort of using these simple techniques. That's pretty much it, guys, for today's video. And I just wanted to go over how I make my risk analysis and my charts a little bit, how I make a little bit extra off of futures trading. This is basically my only goal with futures trading, is just making if you can make a few $100s here and there, that's really going to advance this account, and that's going to set up your percentage that you're trying to get at the end of the year. You know, instead of a 12% year, you can have potentially 25% or 30%. So we're going for that number so that this can, and this isn't for, I don't want to put across the wrong impression that this is to be greedy or just to get, the most money possible. This is essentially, the reason I'm doing this is for financial freedom. It's so that you can grow your account and then live off of it one day. I'll be real. Like, that's just the gist of it, is so that you can retire one day and live off of doing small growth like this. Not trying to get $1 million and buy a Lamborghini off of this, right? It's just a way that you can advance. And if you can listen to my videos and use my advice and go turn it into $1 million mansion, good for you. That's awesome, and I want to hear about it because I'll be impressed. But no, that's not the reason that I'm doing these videos, and that's not really the reason that I'm even trading in the first place. This is just to get by, honestly, so I can sit at the computer for a few hours, make a couple $100s, and then go spend time with my family. So that's what I'm trying to, my overall goal here. But I do appreciate you guys watching, and hope that you learned something from this. And with that being said, we'll see you on the next one. Peace.